So you might be earning good money, but I bet you're still making this one mistake that could absolutely destroy your wealth. And it's the mistake of thinking that your savings will save you. So last week, someone came to me in a complete panic. They were a high earner with decent savings and everything kind of looked pretty sorted on paper. And then boom, fell sick and couldn't work. And they were like, Josh, I've literally maybe got like 2 or 3 months before I lose everything. But here was the weird thing though. They had emergency savings, they had investments, they had cash. But here's the one thing that they massively overlooked. And it's the same thing that most people miss. They didn't protect their income. If you're new here, my name is Josh. I'm a financial advisor in the UK and I've helped hundreds of people to secure their income regardless of what happens to them. And I'm going to show you how to do it too. And by the end of this video, you will have a simple 3-step action plan to secure your income and protect your wealth from its biggest threat. Right, so back to this person that I was working with. They were earning £80,000 a year. They had about £15,000 in savings. The monthly outgoings that they had at the time were about £3,000. So mortgage, bills, lifestyle, all of that sort of good stuff wrapped up into that. Now, that looks pretty solid, right? But then, like I said, they got ill. They couldn't work. And here's where it gets absolutely brutal. After their employer sick pay runs out, they dropped onto what's called statutory sick pay. That is the government's sort of minimum sick pay. We are talking £109 a week. 109. So let me walk you through what happens month by month by month. So month 1, she's still getting her employer sick pay, but as I said, it's starting to drop. Month 2, she's down to that £109 a week. That's 470 quid a month. And her outgoings, well, yeah, they're still £3,000. So she's burning through £2,500 of saving every single month just to keep the lights on. So at that rate, her £15,000 emergency fund, well, it's gone in about 6 months, right? That's the reality here. Wealth built over years can be wiped out in months. And I'm sat there thinking, look, this is madness. She's worked years to build that wealth and it's just disappearing faster than anyone can say market crash. But look, think about it this way. If you've got 20 grand in an emergency fund in your emergency savings and your monthly outgoings are £3,000, what you've got like 6 or 7 months there, and then what? You're left with zero, no safety net, no wealth, no building, no growth, nothing. And here's the real kicker. While you're burning through your savings, you're not doing things like contributing to your pension. You're not investing. You're not building wealth. You're going backwards. You're just trying to survive. So not only are you destroying wealth that you've already built, but you're missing years and years of potential growth. So that is why protecting your income, it isn't just important, right? It's the difference between surviving a crisis and losing everything that you've worked for. And that is a terrifying thought, but it doesn't have to be your reality. I want to ask you a question. Have you ever been in a situation where you've had to dip into your savings for anything unexpected and been in a similar sort of situation to this? If you have, tell me all about it in the comments below and we can all learn from each other's experiences. So how do you actually build a financial fortress that combats all of that? Well, let's break down a very simple blueprint and stick around because later I'm going to show you the one trick to getting a better income protection policy for a fraction of the cost. And to be honest with you, it all comes down to how you calculate just one very specific aspect. So let's talk about what income protection actually is. So you can think of it a little bit like a safety net under a tightrope walker, right? You know the ones. You've all seen them at the circus. Somebody's walking across a high wire up in the air and they've got that net underneath them. And it's not because they plan to fall, but because they don't want to hit the ground if they do fall, obviously, right? That's exactly what income protection insurance is. It's a safety net for your income. If you can't work because of something like illness or injury, it catches you. It's just an insurance contract, like a mobile phone insurance contract or something like that, that replaces a percentage of your salary if you can't work, so that you don't have to burn through your life savings. Now, here's where I show you exactly how it works. There are 3 key features pretty much broadly that you need to get your head around. So first up, the payment amount. So most policies will pay around 60% of your gross salary. Key phrase is gross. So if you're earning £50,000 a year, you'd get about £30,000 payout. Now, I know what you're thinking, Josh, that's not enough. But here's the thing. You don't pay tax on that 30,000. You don't pay tax on the payout. So it doesn't have to be so high because you're not paying tax on it. Plus, of course, you're not spending money on like commuting to work or lunches or anything else like that. So that 60% often goes a lot further than you might actually think. And here's the thing. You want to go for the maximum coverage that they will give you. There is that upper limit of around 60 to 70% maybe sometimes, but try to get the maximum. Don't try to save a few quid by getting like 40 or 50%. Get the full 60% because when you can't work, look, you're going to want to be as protected as possible. The second feature is what we call the deferred period. This is just a jazzy way of just saying how long you have to wait before the policy starts paying out. So the point from when you go off sick to when the policy actually starts paying out. So here's what you actually need to do. Find out your employer's sick pay entitlement. So if you've got a job, more often than not, your employer will have some sort of sick pay benefit in there. If your employer gives you 3 months full pay when you're off sick, then what you want to do is have a 12-week deferred period. If they give you 6 months, then you want a 6-month deferred period. What's that in weeks? No idea. But essentially, you want to match whatever your sick pay entitlement is before your payment kicks in. Because the whole point here is that we don't want to touch your cash savings, right? We want your employer sick pay to cover that first, and then the income protection policy kicks in straight after. So that way, you're appropriately paying for a benefit that you need, but you're also making sure that your emergency savings and all those things are not tapped into and stay exactly what they're designed for emergencies. So again, just getting that right is a really, really good thing to do. The third feature, easy for me to say, is actually how long the policy lasts for. So ideally, you would really want this to run until you retire, because you never know when you might need it, right? You could be 35 and get ill. You could be 55 and have an accident. You want that protection to be there for your entire working life, essentially. So that is what real income protection means. Ensuring your essentially income is coming in regardless of what happens to you. It's not complicated. It's not rocket science. It's just a single monthly payment for an insurance policy that replaces your income if you can't work. Like, think about this. If you had a money machine in your basement downstairs that spat out £3,000, £4,000 a month, how quickly would you insure that machine? Straight away, of course you would. You are that machine. So don't forget that. And you want to insure yourself just to make sure that everything is as secure and as tight as it can be. Your income is the absolute fuel. It's the fire. It's the fuel to your financial future. So don't underestimate this. Look, if you're finding this breakdown helpful thus far, do me a quick favor and hit that like button. It tells YouTube that it's valuable information and helps me reach more people like you. So now, what you need to know also is that there's different types of cover, okay? So this is a really, really critical differentiation. The two types of cover are for broadly different situations, but they are as follows. You have own occupation cover, which pays out if you can't do your specific job. Then you have any occupation cover, which only pays out if you can't do any job at all. So in practice, you want cover that pays out if you can't do your specific job. So for example, if you're like a surgeon and you hurt your hand, for instance, you could get paid out even if like technically you could stack shelves at Tesco's, for instance. So it wants to be in relation to your specific job. So think about your own personal circumstance, and that is proper protections. It means that you're protecting your career, your expertise, your professional status, essentially. So I would always try to lean into essentially the own occupation cover. Now, I know what you're thinking, Josh, this sounds expensive, mate, and I get it. But what I want to do is just run through some numbers with you and run through some maths. And if you're not convinced that this is something that you need to do, I don't know what else is. So let me show you the straight up maths here, essentially. So for most people, income protection costs about 1 to 3% of their gross salary. Now, this is a huge generalization. But if you're earning, say, £50,000 a year, you may be looking at like 500 quid, 1,000 a year in terms of the total premium to cover your insurance. So that's, like 40 to 100 quid a month. Now, I have deliberately inflated these figures, and it will depend on how much what your health is like and how much you actually want to claim. Because obviously if you're claiming for way more, it's going to be more expensive. But this is not a bad guide to go off, about 1% of your gross salary. But here's the thing. You're probably sitting there going, well, yeah, that's a fair amount of money, right? But I look at this very differently. I think this is a better use of your cash than simply just saving or investing it. So for example, if you were planning on saving £500 a month, then you're better off saving £450 a month and spending £50 a month on income protection. Because rather than just stacking up those 500 quids into your bank account, which we've already talked about why that might not necessarily be the best option, that £50 protects the source of all your future savings. So without your income, there is no savings to make, essentially. But look, forget about the cost just for a second. Let's talk about something that I think is massively overrated. Peace of mind. The freedom that you get from knowing that if the absolute worst thing happens, you get ill and you can't work, your family is completely secure. Well, to me, that's priceless. I've got a family, and you could put a 0 on the end of my income protection policy premium at the end of the year, and I would still pay it. That is real value. And it makes you think like, yeah, I'm doing my job as a provider, and I'm essentially making sure that whatever happens to me, my family, my outgoings are completely protected. That to me is way more impressive than anything to do with, I've got a big investment portfolio or I've got loads of savings accounts. Okay. That to me, as an advisor who's seen this over the last 15 years, that is way more impressive to me. So now I want to talk about a simple action plan to actually get it right for you. So there's a couple of niche, nuanced parts to all of this that we've talked about, but essentially there are two main routes to putting this all into place. Okay. Option one is something that I prefer, and you're probably going to say, of course you do. But option one is going through like a protection advisor, a financial advisor or a protection specialist who can help you make decisions. Honestly, this is what I would recommend for most people. So you can just find them on Google or go through a really good resource called Unbiased. So it's unbiased.co.uk. The good news is here that you don't actually have to usually pay a fee for these advisors, because the insurance companies pay them directly. So it doesn't actually cost you anything extra. But for me, here's why this route makes sense. So if this is something you don't know anything about at all, they will be really, really good at providing this tailored advice, which essentially means that they take into account your specific information and your specific circumstance. So they'll look at like your job, your income, your employer benefits, your family circumstances. Then they will match the policy features to what you actually need. Because honestly, even now I get confused with all the different types and all the different variants. They're not all the same. And you want to make sure that whatever it is you end up with actually does the job that is correct for you. And that can be a big sticking point, and it can be something that really you can just pay a lot of money for things that you don't need. So I would always say go with a protection advisor. But of course, there is a second option, which is to do it yourself. So you can just simply Google income protection, or you can go on like Money Supermarket or Compare the Market or whatever, whichever one you actually want. But I would honestly say only do this if you are absolutely certain about the features that you actually need for your circumstance. Because like I said, if you get this wrong, you might be way over covered and spending loads and loads of money on stuff that you don't need, or undercovered and you find yourself in a sticky situation that isn't, right for you. So all of those features that we spoke about before, the payment amount, the deferred period, the policy duration, all of those things, if you know exactly, what it is you want to do with those things, then great. Just go straight to Money Supermarket or Compare the Market and just do that. But as I said, I would always go for option one in the first instance, but I totally understand why you would want to do it yourself, essentially. Just make sure you get the right features. Now, I just want to talk to you very quickly about these big common mistakes to avoid, and we've kind of touched on them a little bit. Firstly, don't just go for the cheapest policy. You've got to check that it's actually covering what you want it to cover, because as I said, you don't want to just go for really cheap and then end up in something that doesn't do the job. Secondly, don't choose a sort of really long deferred period just because it's cheaper. So it's kind of the same as option one. Third, don't assume your employer benefits will always be the same and will always be there. Companies change their sick pay policies all the time. So just make sure you keep a good understanding of what you're entitled to and marry it up to exactly the types of policies that you need and the right features, essentially. Look, income protection is the safety net that secures the foundation of your wealth. It's something that I've seen time and time again throughout my career. But once that foundation is solid, you need to know how to manage your cash flow properly, because there's no point in protecting your income if you're spending it all and never building any wealth out of it. The biggest problem that I see is people trying to budget with like complicated systems and spreadsheets and apps. They always fail. But there is one simple method that actually works, that I've seen work time and time again. It's the single number method. One account, one number, done. So watch this video next where I'll show you exactly how to set it up. It's the only budgeting system that you'll ever need, to be honest with you. And in all honesty, it's the only one that I've ever seen consistently work. So give it a click. I'll see you there.